Hello everyone! Many big tech giants such as Apple, Amazon, Google, Microsoft and Meta were smashed last week, with a few of them falling by more than 10%, which is very uncommon. Not only that, some of them created new bear market low. Amongst them, there are a few interesting technical charts which I will be sharing in this video. Anyway, Nasdaq suffered its worst trading week since January this year. This massacre was likely triggered by Jerome Powell's speech on Wednesday. On top of that, there were quite a few things to digest from last week and for this upcoming week, so do stay on to find out more. The stock market actually started last week quite decently, and the pivot came on Wednesday where investors realized that the Fed is not going to pivot. Specifically, other than delivering another 75 basis rate hike on Wednesday, Powell shared that the rates should rise to the 5% range, higher than the 4.5 to 4.75% range that was projected in September. What further worried investors was that he said the following: "If we were to over-tighten, we could then use our tools strongly to support the economy, and the cost of not tightening enough and letting inflation become entrenched will be much higher potentially." To put it in simple terms, it means that the Fed would rather over-tighten the monetary policy and send the economy into recession than allowing the high inflation to stick around. The sensing that I have gotten was that the Fed is even more hawkish now, and as a result, the stock market plummeted. And then on Friday, we received two reports, namely unemployment report and non-farm payrolls. The results were mixed and they left investors divided. Why so? Let's have a quick look at the stats. US payrolls came above expectation as it grew by 261,000 in October. On the other hand, unemployment rate rises to 3.7%, which is also above expectation. So what do they exactly mean? It means that the US added more jobs than expected despite the aggressive monetary tightening policy by the Fed. This also means the job market is still strong and inflation could potentially still be high. On the other hand, the higher unemployment rate may be interpreted as a sign that the labor market is slowing down. These mixed results could be why the market whipsawed on Friday, which is swung from one direction to the other in a short time frame. Alright, that was for last week, and I hope this summary had helped newer investors in understanding what had happened. So what's coming up this week? Two key events, and they are midterm elections on Tuesday and the release of CPI data on Thursday. Sharing some interesting facts for midterm elections, and that is the stock market tends to do better with a divided government, where control of Congress was split between Republicans and Democrats. To add on, a recent analysis from Bespoke Investment Group shows that stocks tend to surge in November and December during midterm election year. The year after usually has good results too. But of course, a big caveat here, historical data doesn't guarantee the future stock market performance, and so far this year, the S&P 500 has performed much worse than the other typical midterm election years. Now let's talk about CPI data. We all know that this year's stock market has been largely driven by inflation and CPI numbers, together with Fed's rate hikes. Therefore, a stronger than expected number on 10 November could give Fed more reasons to be super hawkish. Anyway, I half suspect that the Fed already knew the number last week when Powell came out to speak to the press. Let's say if inflation report shows a decline, then the market could bounce. But I think we are still some way off from exiting the bear market. Okay, some food for thoughts. On one end, historical trend shows that the market usually went up after midterm elections. To add on, November and December usually are strong months for the stock market, especially with the so-called Santa rally that typically takes place towards the end of December and early January. On the other hand, the market sentiment is still very weak, the economy is slowing down and Fed is raising interest rates like nobody's business. With these macro factors, the stock market should continue to go down, at least on paper. So, which side are you on? I will share my views towards the end of the video. Okay, moving on to the technical analysis segment. There are some interesting charts to share, but before that, if I may, could you help to hit the like and subscribe buttons please? I really hope to grow my channel and reach out to more people. Okay, anyway, let's have a look at SPY on the weekly chart. Something noteworthy to highlight, and that is the 50 moving average is about to cross the 100 moving average. Though moving averages are lagging indicators, but the last time around this happened, it was in 2008, and the market plummeted further. So watch out for these two lines in the next few weeks. On the daily chart, if you recall, I shared in my last video that we could face resistance at 389, and if it gets rejected, we will come back down to retest 15 moving average. And from here, it needs to bounce above 389 to be bullish, otherwise it would be bearish. And that was what happened. We tested 389 on 3 trading days, came back down to 50 moving average, but did not manage to go up. Right now, the immediate resistance would then be the support turn resistance 50 moving average at around 379, and coincidentally 379 is also the 38.2 Fibonacci retracement level. Therefore, this forms a big resistance level in my opinion. And in order for SPY to be bullish, it needs to break and close above this level at least for a day or two. Then we can expect it to retest 389. On the downside, I think 367 is a very key support level. If it breaks, there is a high chance we could slide down to 355. That's a good 12 points downside. Also, do watch out for the red dotted downward trend line. Bulls wouldn't want SPY to fall back into the downward channel again, because when that happens, it's super bearish and we will have a new 52-week low. But something interesting to highlight, that candlestick we had on Friday looks a bit like a dragonfly doji candle, though some people's version of dragonfly candle does not have an upper shadow. Nevertheless, this is a slight bullish candlestick as it means the bears flush it down during the day, but then bulls managed to bring it back up near to the opening price before the market closed on Friday. But this does not mean bulls are taking control. Watch out for the next candlestick for confirmation, where it should close above Friday's high of 378.8. And guess what? Does this coincide with the resistance level of 379? So there you go, 379 is a key resistance level. Next, we have Apple. Before I dive into the technical analysis, I just wanted to share that one thing investors should learn in this bear market is never chase the upside right after good earnings. More often than not, we will come falling down quite heavily. It happened to Tesla and a few other stocks, and now Apple as well. In my last video, I have already warned that after that 7% parabolic run to the upside, we are due for a pullback. Anyway, going back to the technical chart, it's quite interesting because we are at a zone of little support, maybe a small one at 138. But what doesn't help is that MACD is curling down, which is a bearish sign. In my opinion, 134 has to hold. If it does not, we will likely feel the small gap at the bottom at around 132, followed by testing the June's low of 128. When that happens, I will definitely pick up more shares. In fact, I have already picked up a few last week. I may also be selling put options if it goes further down. For info, selling put options is a slightly bullish move. Again, this is not financial advice, okay? So anyway, why I found the chart interesting is because as much as it looks bearish, we could still potentially form a mini double bottom here, which is a bullish sign. This also means we could have a little bounce. Maybe, just maybe, we could bounce up to fill that gap at 142 to 144, and then hit the resistance at 144 and fall back down. When this happens, it sort of validates both bulls and bears thesis that I have painted, aka a super short-term bounce and then fall back down to resume the downtrend. But one key level to highlight, there is 144. If we can break and close above 144, then it could fly to 149 to 150. That's when the bearish thesis of hitting 128 may be temporarily invalidated. For Tesla, another interesting chart. We all know it's a super volatile stock, and I think it can get even more volatile in the weeks ahead. When I zoom out the chart, as much as I don't like to say it, but this looks like a bear flag to me. If this bear flag is validated, we could potentially break the recent low of 198 and then fill up the gap at 188 to 190. And further down, there is another tiny gap at around 175. At this level, the next meaningful support is actually around 155. It's quite scary. So yeah, I hope you get it. If Tesla starts filling the gap at 188 and doesn't bounce back up, the downside could be massive. What didn't help is that the MACD is on its way to curl down, although not confirmed yet. By the way, a quick disclaimer, I am not saying that Tesla would definitely drop to this range that I have shared. It's more of I don't want you to get too shocked if it ever happens. Okay, on the upside, 225 is the immediate resistance. Breaking above it means nothing in my opinion. We need to get above 242 and the green dotted upward trend line before we can talk about being bullish. By going above 242, it may also invalidate the bear flag. Alright, Microsoft. Other than Apple, I have also picked up some shares of Microsoft last week. Can you see that two blue dotted lines? We have finally went into this consolidation zone and stayed in it. I have been talking about this area for I think at least half a year, as I have always shared patience, pace, and trust the technicals. Personally, I think this consolidation area of 200 to low 220s is a good place to accumulate some shares of Microsoft, at least for me. Come on, this is the second biggest company in US with strong cloud business and sticky business products. I am excited to pick up some shares, man. Anyway, the support level of this area is of course 200, and if that breaks, we could first fill the tiny gap at 187, and if it doesn't bounce up, don't be too alarmed if it hits the pre-pandemic high at 185.9. On the upside, very simple, resistance level at low 220s followed by 240. I am expecting heavy resistance between 238 to 245 where there is a gap there, as well as where the current 50 moving average sits. Lastly, Google. Google just got slaughtered last week. Let me show you something similar to Tesla's chart. Check out this bear flag on Google. So when it was formed and when it went down, this is how much it can slide down. So go back to Tesla's chart if you can. Do a comparison. If Tesla boosts do not quickly invalidate the bear flag, a potential waterfall could happen and it can be massive. Anyway, for Google, I almost wanted to sell a put option, which is a slight bullish move, but I saw it breaking down from the bear flag last week and MACD was curling down too. As a result, I held back my trade. So once again, trust the technicals. And like and subscribe if you haven't done so, alright? So right now, I think we could have the chance to fill a small gap between 82 to 83 followed by 79 to 80. We have a strong support at 75. On the upside, we have many hurdles to clear. First, it will be the support turn resistance level of 90, followed by the gap between 98 and 102. That is also where another resistance level sits, which is 100. I am expecting sellers to step in around this area. A big thank you if you have watched till here. Some end thoughts from me. What I learned this year is that the market driver of 2022 is actually the Fed, or specifically Jerome Powell. Every time he speaks, the market moves crazily. His words literally worth billions of dollars, as we saw such amount of money got wiped out from the stock market last Wednesday. Anyway, going back to the earlier point on whether the stock market will rally into year end, my thoughts are the broad market is holding up currently, likely due to elections. I mean, as you can see, most of the biggest tech stocks have been massacred, and yet S&P 500 still has yet to hit a new low. But as to whether we will have a rally after elections and going into Christmas period, well, maybe. But some words of caution would be, having a rally now is trying to fight the Fed. It's a super tall order, and as we all know, going against the Fed usually doesn't end well. Therefore, if we ever get some nice rallies in the next 2 months, I would urge investors to be extremely cautious simply because all the headwinds such as high inflation, high interest rate, and slow economic growth remain. Every rally will likely come with extreme pressure to push it down. Lastly, I am of the view that investors and traders shouldn't solely rely on historical data on midterm elections and seasonality rallies to make their investment or trading decisions. There are way too many things happening right now that could easily supersede the positive performance during post-midterm elections and also center rally. Alright, that's all for this video. Please comment below if you're looking forward to a potential year-end rally, or are you very bearish towards the current market? Would love to hear them. And lastly, if you think my video value add to your research, please help to hit the like and subscribe buttons. Thank you.